Thanks for everyone for joining us and welcome to LPC's first quarterly market update of 2025. For those of you that are new to our webinars, firstly, welcome. How we like to proceed is by the LPC team of experts providing a high-level overview of the Q4 2024 status of the ANZ office, retail and industrial markets, and we'll be providing this commentary from a tenant's perspective. So presenters today joining me are the cream of the crop here at LPC. We have Graham Postma, who will be discussing all things office, Adrian Gerber, who will be our specialist in all things retail, and Ken Lamb, who will be discussing the industrial sector. So again, starting off, we'll have the office, retail, then industrial market snapshot. And if we have time at the end, we'll have a Q&A, and please feel free to ask questions throughout the webinar. There's a function on the bottom of your screen. Please ask whilst we go along. So just kicking off, I'll touch on some of the key recent sort of articles in the AFR on the ANZ New Zealand office, retail and industrial sectors and highlight some of the trends. So for office, return to office remains a key topic, continuing to be in the headlines. As we know, some of the larger tech businesses are demanding all their staff to return full-time, 5 days a week. And now Trump has mandated a 5-day office attendance for all the US federal staff. Landlords are saying that this will, for their benefit, show in Australia as well. And we'll see that in all the markets. Service office and co-working is making a resurgence as businesses still do not know what the future looks like, and they want flexible terms. We're even seeing Dexus rolling out short-term accommodation specs in their buildings, like at Australia Square, where they've taken 2 floors and providing short-term spaces available for there. And those were snapped up in 1 to 2 months. So the interest is definitely there. Moving on to retail, with the RBA not dropping rates, discretionary spending was healthy during the Black Friday sales period, but weakened in December in the lead up to Christmas. While some forms of retail remain a hit, like sports, clothing, activewear, others saw a decrease in trade. It depends on the different service products provided, and Adrian will touch on this further and how the different markets vary for retailers. Then finally, onto industrial. Whilst there are signs of high vacancy, landlords are still reporting good profits in terms of their industrial investments, as there is a time delay between what is actually occurring and what's being reported. As we always discuss, landlords generally manage the information and it presents it towards their agenda. It's important for tenants in the industrial and all other markets for that matter to understand the situation in your market, as there are different sub-markets within the overall markets which impact your lease negotiations. Ken will try and make sense of it all in the industrial sector. So kicking off with office, if we go to the next slide, we'll have the overview of the vacancy data, look at the market status and trends, and then we'll touch on the tenant perspective. Thanks, Graham.
Thanks, Ed. So this morning we had the release of the latest property market, PCA office market report, and the vacancies around the country as at 31 December, all of which are on the slide there. Overall, the Australian CBD vacancies remain pretty flat. It's increased from 13.6 to sort of 13.7%, with the non-CBD office vacancies stable at about 17.2%. You've got your CBD vacancies increasing in Sydney and Brisbane, mainly due to the addition of new supply, but it's remained flat in Melbourne at 18%, which has the highest vacancy across the country. Probably not a big surprise for many, whilst Perth, Adelaide and Canberra all recorded declines in vacancy. Interestingly, the East Coast markets are forecasting new supply in each of these markets at over 5% of the current market size between sort of 2025 and 2028. It's ranging from sort of 21.1% in Canberra, almost 27% in Melbourne, and 48.1% in Sydney. So that's the level of pre-commitment, but there's some big increases. But yeah, the level of pre-commitment on those new buildings coming online, other than Brisbane, are all sitting at below 50%. So this would indicate that there's further pain in terms of the landlord side and benefits to the tenant side from a vacancy perspective, unless we see a significant increase in demand or significant relocation into the CBDs, or alternatively, significant withdrawals from the market of additional stock. The flight to quality remains a main trend, and I'll talk about that a bit further. I think it'll be interesting to see what happens with the work from home changes in sentiment that's happening now. A lot of tenants have used that sort of feature in the last few years to reduce their occupancy, put space savings into better quality premises. And there's also a desire for the buildings that have better quality tenant amenity, such as end-of-trip facilities, wellness facilities, retail facilities and alike. It's been a mixture of attracting their staff back to the office, as well as the big driver of attracting and retaining staff generally. It's interesting to see the recent change in that sentiment around work from home, how that's going to increase occupancies around the city. Probably the market that stands to benefit most from that would be Melbourne. I think most of the other CBDs now are probably back to or greater than pre-pandemic levels. So that'll be an interesting one to see for the coming year. You'll see this sort of slide throughout the presentation on each of the market areas, but what we're looking at here is our barometer that we use in terms of a tenant unfriendly market balance versus to a tenant friendly market. And each of the presenters will sort of let you know where the individual sectors sit. I think it's fair to say at the moment the office market generally sits in that tenant friendly environment, and that's where we try to shift that whole feature of what are the least norms to a tenant friendly sort of environment across that cost, risk, flexibility, the obligations and guarantees. It's not always achievable, but you've got to ask the question. What you'll see, what I'm also going to cover on now are some of those trends. The flight to quality, a flight to value is probably another way of putting it as well. The vacancy rising in that secondary grade stock, the reuse of existing fit outs and tenant demand. They're probably the four key features we're seeing. It remains a tenant friendly market across pretty much every market in Australia. This is compounded by the shallow depth of tenants in the market. There's fewer tenants competing for the same amount of space. Many tenants are still consolidating and reducing their footprint. This means landlords are well aware that vacancy is likely to remain stagnant or in fact increase in some markets for some time, and therefore they need to be competitive if they want to secure deals. It's a clear trend of that flight to quality. It's not just the better grade accommodation, it's better location and better amenity as well. When I'm saying now flight to value, a number of the high-end A grades are now being seen as being able to offer a comparable sort of level of quality at the same level of services, but may present a better value proposition across those markets. What this is seeing then is a rising vacancy across your secondary sort of stock. As tenants renew on reduced footprints and relocate to those better quality buildings, it's going to be challenging for those landlords of secondary buildings, particularly within non-core CBD locations. There's examples of pockets in Sydney that have had vacancy for 18 months and with tenant demand simply not there. And I think those owners are now looking at what they need to do to their buildings in terms of capital expenditure and upgrades to make them competitive in this market. The reuse of existing fit outs, it's a trend we've seen, I suppose, over the course of 2024, and there's sort of two sort of fold in this regard. It's reuse of existing fit outs, which also then flows on to a greater number of major tenants sort of renewing. If there's not a fundamental reason for a tenant to relocate, if the quality of their fit out's fine, if it's still relevant, if the building quality and location, everything is suitable, then the best outcome in a lot of cases for these tenants is to negotiate a renewal with their existing landlord, where they can then take the vast majority of that incentive as rent abatement over the term of the lease. We've seen significantly higher fit out costs around the markets, with 50 to 100% increases in some of those costs. The more expensive fit outs for the top tier law firms, for example, now are probably in the order of $5,000 to $6,000 a square metre. So that means it makes more sense when tenants vacate for a landlord to look at what they can reutilise, particularly around the built form. It might be a change of workstations, and obviously it'll need a refresh and general works in terms of carpets and lighting and ceilings. But if they can retain a lot of that built form, then that presents some significant capital savings. capital is tight and more expensive these days. So landlords are looking at how they can use less capital to still get a better outcome. This provides some good advantages for tenants, because it also means that if they're not spending as much capital on upgrades, there's potentially more money available in terms of the tenant incentives. Finally, tenant demand has been limited across all the markets. I know from my point of view in Perth, CBRE have quoted that it's the level of inquiry and transactions is probably down 25% year on year compared to 2023. Given the current economic and geopolitical uncertainty, we've had the outcome of the US election, which is, some would say, does it give you more stability or sort of more certainty? I think it gives you probably a little bit less at the moment. And certainly we've got some major elections around Australia which will cause a period or a hiatus period until those changes are made, and we see what's on the other side of those. Landlords are under increasing pressure. Building values have come down significantly, some in the order of 25 to 30% in terms of book values. As I said, the availability of cheap capital for capital improvements, fit outs and alike is very limited. So this will make attracting tenants more difficult. It also creates opportunities for tenants, particularly those that are able to fund their own fit outs, where they can then push for greater levels of incentive and in terms of abatement and the like. Flexibility of lease terms continues to be negotiated by tenants that require and sought by tenants. They need greater flexibility around size, term, how to deal with merger and acquisition activity. So there's a lot of future uncertainties in that sort of space. And this is probably the market where you can take advantage of the favourable leasing conditions to build that flexibility into your lease. And that's certainly how we've been advising our clients, mainly in terms of early termination rights, contraction and expansion rights. ESG reporting for businesses is becoming the new norm, and it's important that the credential in order to continue to do business with large corporations. It's a trend for larger businesses has been to leverage the building and the landlord that can contribute towards achieving those targets set by their individual businesses. This has become a significant consideration when selecting the right building and the right landlord partnership, particularly for the major occupiers. And finally, going early. After years of uncertainty in relation to the way we're going to utilise our office space post the pandemic, in particular, sharing arrangements on that work from home, and tenants are starting to show signs of going earlier to the market than they might have done pre-COVID. They're wanting to take advantage of the state of the market in each of those areas. It's particularly important, and I probably can't stress this enough, for again the major occupiers. There is a shortage or a declining amount of contiguous space available across all markets, particularly within the premium and some of the A-grade buildings. So going early and giving yourself time to plan with contingencies and everything in place is going to be a critical part of it. Running out of time is the worst sort of thing in terms of being able to create the leverage you need to get a really good outcome. So looking at it from a tenant perspective, this covers across the strategies that we sort of try to implement from our clients and the associated outcomes that they generally achieve. We continue to use this table in the different sectors and highlight the relevant strategies applicable to each, having regard to the current market conditions. For the office sector, our primary recommendation to clients is to focus on the strategies highlighted in orange: the portfolio optimization, review and reset, the lease restructure before expiry, and go big for substantial change and risk transfer. In terms of portfolio optimization, often tenants sign a lease and don't look at it again until closer to expiry. It gets put in the bottom drawer, and unless there's a question or a dispute, it just stays there until 6 months out from the lease expiry. Undertaking a review of the portfolio against current business requirements and market condition often presents a number of opportunities that can be leveraged to reset and restructure a lease in a portfolio. A good example is a legal firm that has traditionally been reactive to lease events. Following a recent review of their portfolio, the business has realised that many of their leases don't align with their business strategy and are generally unfavourable. The business has reset their offices in leases in Sydney, Brisbane, and in the process of doing so in Melbourne, moving to higher quality accommodation with a fit out that is better aligned to the business at a similar occupancy cost to a renewal. We had another client, sorry, I'll just go one more. We had another client in Perth that midway through their lease term decided it was a time to review it in terms of what the market looked like, what their needs were. And we were able to negotiate a significant reduction in their overall costs with an extension, a blend and extend type deal well in advance of lease expiry.
Perfect. Thanks, Graham. Moving on to the retail snapshot. We'll look at the leasing trends, then we'll have an overview of all the different sectors, and then we'll, of course, get the tenant perspective. So moving on to the leasing trends, the Australian retail market continues to show mixed performance across the different sectors. In large format retail sector, vacancy has decreased due to limited new stock entering the market, and this supply constraint has contributed to sustained demand for available space. In contrast, vacancy rates in other retail sectors remain relatively static, though notable disparities exist within the different sub-markets. So strip retail, for instance, is experiencing higher vacancy rates in some locations, while shopping centres continue to maintain tight occupancy levels. These variations highlight the evolving nature of consumer behaviour and the shifting dynamics within the broader retail landscape. Despite softening retail spending with households adjusting to cost of living pressures, we continue to observe upward pressure on effective rents. Across most retail markets, rents have increased while incentives have declined, reflecting continued demand for well-located retail spaces. One point of relief for retailers is the easing of the CPI-linked rent increases. After reaching a peak of 7 to 8% in 2023, CPI has now reduced to around 2 to 3% in most markets, providing some stability for tenants facing cost pressures. I'll now hand over to Adrian.
Thanks, Ed. So as Graham highlighted the barometers within the office market, the lease norms for retail remain unfriendly due to the supply side power and market coverage that landlords hold as a collective over retail tenants, as well as restrictions within retail leasing acts. With the market conditions, they are quite varied, as Ed said, over the different types of retail. In theory, they should favour the tenant. However, landlords are not taking into consideration the needs of tenants in light of the current economic conditions. The retail market experiencing difficulty due to inflation and interest rates, landlords should look at ways they can assist their tenants and create long-term relationships, not hinder the tenant. In a recent example, a shopping centre landlord was seeking an inflated rent that they weren't prepared to negotiate on. When the landlord found out that we had found an alternative location outside the centre for 75% less rent, only then were they prepared to drastically reduce the rent, which was too late. A win for the tenant and a rare example of a retail tenant creating leverage within a shopping centre, but it just shows how difficult negotiating with shopping centre landlords can be and how much power and information they hold. Go to the next slide. So the LFR sector received a boost in December on the back of the longer Black Friday and Cyber Monday periods, with household goods retailing increasing by 1.6% from November. The lack of new property space in large format is still continuing to force rents to increase, with limited opportunities for new and relocation sites, and a lot of deals being negotiated off market. Just recently, we received information on a new LFR development in suburban Brisbane, with rents pushing $450 a square metre. However, for some tenants, the rent increases along with the economy and the hike in construction costs is making new sites difficult to justify. And we're seeing some opportunities present themselves whereby existing tenants cannot keep their doors open. A good example of this recently is the Mosaic brand collapse and Rivers, with sites now presenting opportunities for LFR retailers who can move quickly and have a mandate to open more stores. Most landlords are accepting of incentives on new sites. However, incentives on renewals are almost non-existent given the increased cost of borrowing money. Time and skill is required to achieve results in this area. Currently, many large format clients are investing in data, market research and benchmarking, as well as network plans to help inform them from a portfolio perspective on where to select the best locations, especially given fit out costs, the reduced amounts of CapEx available, and the need to maximise store sales productivity given the lack of floor space available. Again, whilst the Black Friday and Cyber Monday promotions in November saw sales up year on year, sales did slow down in the pre-Christmas and Boxing Day periods. Retail spending rose by 1% in the December quarter. However, the month of December itself fell by just 0.1%. Clothing, footwear, and personal accessory retailing fared the worst, with a 1.8% drop in December, along with cafes, restaurants, and takeaway food services with a 0.5% drop. As we move into quarter one, shopfront conversion becomes more important than ever, as until we see interest rate cuts, Q1 will be challenging for retailers while shoppers and their credit cards recover from the November and December sales periods. Shopping centre landlords are still seeking rent increases on renewal by 5 to 20%, along with longer lease terms and fit-out upgrades. Many tenants in larger shopping centres continue to be affected by relocations on renewal, as the landlords revisit tenancy mixes and seek international tenants and new brands to maximise turnover and retail growth. As with large format retailers, the shopping centre sector is also feeling the effect of the Mosaic brand collapse, with the likes of Nonny B, Miller's, Rockman's and Autograph closing. However, this is creating opportunities for retailers. One client that we are currently working with is moving from online retail to bricks and mortar by committing to 10 sites around the country on short-term reduced rent leases and taking advantage of reusing existing fit-outs. As we discussed with large format retail, landlords are only providing incentives on new sites, and even then the amounts are reduced or reflected within a higher face rental. With the CBD, retail rents have remained stable over the past quarter due to the effect of interest rates and reduced discretionary spending. However, the CBD will more than likely never return to pre-COVID levels due to the change in office working habits, especially Melbourne, where food and beverage retailers dependent on office workers are continuing to struggle. If a landlord wants to seek a new cafe tenant in an office building, they are more than likely having to subsidise a large percentage of the normal asking rent. In the suburban market, it is two-paced. In the busy prime suburban strips like Chapel Street, South Yarra, James Street, Fortitude Valley, plus tourist areas such as Noosa and Burleigh Heads, vacancies are rare, rents are increasing, and the new opportunities are mainly sourced off-market. However, in the secondary locations, there are many options. However, landlords are hesitant to provide generous incentives given most are smaller investors. Tenants are also much more considered in their decision-making with new sites. Given the investment required for a fit-out and the challenging economic conditions, tenants are only considering sites that tick all their boxes from a location, signage and parking perspective. No longer will they consider a secondary location that they may have accepted pre-COVID, as they want to ensure that their business has the best opportunity to be successful. Landlords need to continue to be reasonable, implement rents reflective of market, and recognise the current pressure on retailers. There are a number of strategies that a tenant can enact to receive favourable outcomes within the retail sector. I've highlighted 2 strategies in orange that have relevance to the slides that we've just previously gone through. First is premises due diligence and negotiation. Use data, consider customer demographics, research rents, and benchmark against competitors to ensure that the entire portfolio performs and the sites are in the right locations. And then go big for substantial change and risk transfer. Look at situations like the Mosaic collapse and like the client we are working with to use it as an opportunity to maybe take some risks of opening more stores, which will develop into potential of substantial increases in revenue. Thank you.
Thanks, Adrian. So finally, we're moving on to the industrial market. Again, we'll have the overview, the current status, the trends, and the tenant perspective. But just touching on the overview, the Australian industrial market is undergoing a shift with vacancy rates increasing, offering a welcome reprieve for tenants who have struggled with historically tight conditions. This rise in vacancy provides more leasing options and potentially greater negotiating power for occupiers. In New Zealand, these rates have remained relatively the same. However, we expect New Zealand to follow Australia and see an uptick in vacancy over this year. The boom in e-commerce-driven demand for industrial tenancies appears to be slowing down, contributing to market stabilisation. Various research shows rising vacancy rates and stagnant rents. In Sydney, industrial vacancy rates have increased to nearly 4% after hitting record lows in 2023. Across Australia's east coast, vacancy rates have also risen, now stabilising around 3.5%. Effective rents are under pressure due to high tenant incentives, which have doubled in some areas over the past year. However, despite these trends, tenants are still facing supply constraints. Whilst tenants may benefit from slightly more choice and greater incentives, the overall cost of securing space remains high due to continued demand and limited new developments. Thanks, Ken.
Thanks, Ed. As you touched on, the e-commerce has placed a considerable amount of pressure on the industrial space. And with the slowdown, this has been one of the major drivers for the warehouse demand over the last kind of 2 to 3 years. As a result, it's put pressure on vacancy rates, which have increased, and reduced effective rentals, with the vacancy rates increasing for the first time in over 2 years. The rapid growth in demand for industrial space seems to have slowed down as the market adjusts, which indicates there is a correction happening in the marketplace at the moment. As Ed mentioned, vacancy rates in all major Australian cities have risen, but Australia still has some of the lowest vacancy rates globally. Without a significant influx of uncommitted stock, vacancy rates are expected to remain at these levels for the next 12 months. As the demand softens, there is pressure on landlords to reduce face rents, but at the same time offering higher incentives. In sub-markets, we've seen incentives increase to as high as 20%, which is a sharp contrast to a lack of incentives just seen over a year ago. What are the market trends? As we've alluded to, there is a market correction that is taking place in the industrial sector at the moment. Along with the slowdown, we are witnessing rents decreasing in some markets by as much as 5 to 10%. This is more relevant in stock which is owned by private investors. On the other hand, owners, particularly institutional owners, are still keen to maintain their face rents to uphold balance sheet credibility, which has in turn placed pressure on incentive levels. In some markets, landlords are pushing for rents as high as $500 per square metre, and this in turn are forcing those tenants to consider other industrial markets and even other capital cities. Due to a rise in construction costs and the slowdown demand, developers are now adopting a more cautious approach rather than speculatively building a site, and now they are seeking pre-commitments for tenants before they are proceeding with new builds. Whilst the days of double-digit rental growth are now behind us, landlords are exploring various types of industrial properties, all those with more value-add opportunities. So where do the opportunities lie? The industrial market has been a landlord's market for the past decade. While the market is adjusting to lower demand and some better levels of supply, there is still little leverage for tenants, both in terms of market conditions and lease conditions. And the sustained growth of the market has skewed typically towards the norm, towards the landlord. In order to shift the needle on the barometer back to the tenant, careful consideration of business needs, expert knowledge of marketplace experience, and patience are essential. On the next slide, we'll look at a couple of different strategies that we can assist in order to move the barometer to a more balanced, tenant-friendly situation. As we've alluded to, there is some good news this quarter for tenants. However, there are several strategies that we have used to improve an industrial tenant's position. Our negotiation strategies turn on the 5 key categories of cost, risk, flexibility, obligations, and guarantees. Whilst there should always be attention given to costs in a market such as the current industrial market, driving down costs is not impossible, but it's always a difficult proposition. It's always arguably the better outcome may be achieved by focusing on other factors. Given the market correction, this could be an ideal time for tenants to consider an early lease restructure. By restructuring the lease before expiry. By initiating these discussions now, tenants may be able to secure more favourable terms that reflect both current and future market conditions. This could include bringing forward a market incentive, negotiating capital for some improvements to the premises, and securing a renewal extension that better aligns with the business objectives and goals. Another strategy available is to look at mitigating risk and transferring certain obligations to the landlord via side deeds through a variation of an existing lease. Everything is negotiable, but make no mistake, it is hard yards, and it does take skills and patience to negotiate these terms.
Thanks, Ken. We've gone over time. Sorry, so we'll skip the Q&A this time. But please feel free to reach out to any of our specialists. We've got the emails up here and on our website. So if you've got any direct questions, thank you to our panelists and thank you all for joining. Our next update will be on the 8th of May, where we'll look at the Q1 status. And thank you all for joining, and hope you have a good rest of the year.